Welcome everyone to the next session of working capital management. In today's lecture, we will discuss theory related to cash management. So managing of cash is a very important parameter for every business because we must understand that in finance, cash is called the lifeblood of a business. Too much of blood into our body is going to cause problem. Similarly, too little of blood into our body is again going to cause a problem. The same concept is applicable to the business as well. So in this video, we will decide that how much cash should a business have, what is the optimum balance of cash, how to find the right balance between whether to keep a cash at a certain level, above a certain level or below a certain level. So this decision will be based upon certain mathematical parameters. In today's lecture, we will be having insights related to how to find this optimum balance of cash. Also, we will see that how this optimum balance can be determined with the help of two models. The first one will be inventory model, another one will be stochastic model. In inventory model, we will be seeing that how by dividing the balance of cash into carrying cost and transaction cost, we will be identifying exactly how much cash should be there into our business. So these business cash models are totally mathematical in nature that will tell us the exact value of cash that our business should have. Moving ahead, let us understand that what these cash management models are going to tell us. These cash management models tell us that too much of cash into the business is not a good idea because cash is lying idle into our business. Yes or no? The same cash which is lying idle into your business, you can lend it somewhere and earn interest on it. So too much cash for a business is not a good idea. Similarly, too little the cash for a business is not at all a good idea, because then you will have the shortage to pay salary of your employees, to pay rent of your building, to pay your electricity bills. So cash management models will consider all these parameters and tell you how much exact cash your business actually needs. Moving ahead, in order to decide the exact cash our business actually needs, two types of models are there. One model is based upon inventory. Remember EOQ, economic order quantity. Another model is like a stochastic model. In inventory, we will study Baumol's model, 1952, and in stochastic model, we will study Miller-Orr model. These two are the persons which have told us the mathematical calculation related to how much cash should be into your pocket all the time if you want a smooth running of your business. Moving ahead, uh, inventory type model or the Baumol models, let us talk about it and understand that these models work very much like economic order quantity works, like inventory management works. So just like a business decide how much stock, how much goods to keep so that we are neither overstock nor we are understock, the finance manager similarly decide how much cash should be there so that we are neither overbalanced nor we are underbalanced. So these balances or these model we will be deciding only when if we are able to predict the cash inflow and cash outflow. So specifically, these models are useful only if the prediction of the cash balance is possible. So let me tell you an example. For example, we exactly know that when money will come in from the customers, we exactly know at what time we are supposed to pay our rent, we exactly know at what time we are supposed to pay our salary. So this model is going to work well. The next model is the stochastic model. Stochastic means random. So stochastic model, we will study Miller-Orr model in detail. So these are used when cash flows are uncertain, when they are not predictable. For example, sales and expenses might happen irregularly. They are not happening at a particular intervals in the year. And you can't always predict exactly when money is going to come in and the money is going to go out. So when such prediction is not possible, the Miller-Orr model help us to setting the range of the cash balance. With the help of setting the upper limit and lower limit, we will discuss. So this way the company always know when to invest extra cash outside the business or when to bring in more cash by taking loans in order to avoid shortage or in order to avoid interruptions because of work is not happening in the absence of cash. So if I need to summarize it, I can say that when cash flows are certain and predictable, we use inventory type models. But when cash flows are uncertain or random, we use stochastic models. So in short, the choice of model depends upon whether the company's cash flow is stable or whether the company's cash flow is unstable. Unstable means unpredictable. Now let us look at the Baumol's economic order quantity model, which was invented in the year 1952. So this model is basically based upon the idea that best amount of cash to keep is the point where two kinds of costs are minimum. The first one is the cost of holding the cash, that if we keep cash with ourselves, it costs something. The first one is that cash, that cost. And the second cost is the cost of converting investments into cash. Fine. See, two things we can do. Either we can keep the cash with ourselves, then cost of holding the cash will increase. What is that? That if we are not keeping it with ourselves, definitely we can invest it somewhere and we can earn interest on it. So if we are not earning interest on it and we are keeping it with ourselves, the cost of holding the cash is increasing. Yes or no? Second is we are not keeping it with ourselves. We are investing it somewhere. So when we are investing it somewhere, some cost is involved to convert it into the cash. For example, if I have done a FD of 3 months, but I need cash after a period of 1 month, definitely I will not get entire amount of interest. Also, I need to pay a certain amount as penalty as well. Fine. So that penalty which I am giving in order to take the cash early, that is the cost I need to incur. So we must understand that if we keep too much of cash, we lose the interest. Here is a dilemma, which is holding cost. But if we keep too little cash, we have to again and again convert securities into cash, which will increase our transaction cost. So Baumol's, this model help us to find the sweet spot, that what should be the optimum cash balance that you will invest somewhere else, and what is the cash that you will keep with yourself. This is clarified by this model. So as per this model, there are two main types of costs that are involved in cash management. The first one is the carrying cost. So to understand it, think of it keeping too much cash at your home. If you keep a lot of money in your drawer, the money just sits there and earns nothing. So you lose the chance to earn interest. That's the carrying cost. Fine. So carrying cost of keeping too much cash. For example, if you keep cash in hand, you lose the chance to earn interest on it. That's the opportunity cost, that you are losing interest by keeping it with yourself. The second cost is the transaction cost. So this happens when you don't have enough cash and you need to again and again arrange money for your business. Each time you do that, you pay fees, or you, if you are not even paying the fees, it is involving a lot of time in order to convert a security into cash. So the time which you are investing, the fees that you are paying, the money, the expenses that you are incurring for converting a particular security into cash, that's what is the transaction cost called. So one cost is for keeping too much of cash, and the another cost is for keeping too little cash. So this model will help us to find the balance, that not too much, not too little, only the optimum cash balance. So Baumol's model is very simple. It simply says that do not keep too much of cash with you. It's a loss for you because you are not earning anything on it. You are not earning interest on it. That means carrying cost is high. Also, it says that too little of cash is again a not good idea for you. You will go again and again and sell your investments into the market to arrange cash into your business for it. That means your transaction cost is high. So Baumol's models say that best amount of cash is the optimum balance. So in the same way that you calculate economic order quantity for your stock, similarly calculate economic order quantity for your cash. The question is how? Here it is the formula for calculating economic order quantity for cash. So here you can see that the similar looking formula is given to you. The cash balance, C stands for the cash balance, is under root of 2 into annual requirement. What is the annual requirement of cash you need? Multiply by fixed cost per transaction divided by opportunity cost. So when you will integrate this formula, you will have the minimum balance of cash that you always need to keep inside your business. If you are not keeping it, definitely you are going to suffer losses in future. And if you are keeping more than it, definitely you will earn losses in the form of not earning the money that you can actually earn from that particular amount that you are holding into your business. So this finishes our Baumol's model. And remember, if you carry too much of cash, it will increase burden on you. And if there is no cash, you will be busy in selling the investment and generating the cash and again. Do not fall into the trap. Find a spot that is lying somewhere in between by using the formula for economic order quantity. Now, let's move to the Miller model. This model was developed in 1966, and unlike Baumol's model, which assumes that cash flow is predictable, this model assumes that cash flow is random. Cash flow is uncertain. It is totally unpredictable in nature. So what this model is going to do, this model will set up certain limits. Upper limit, lower limit. If your cash is going above the upper limit, whatever is the margin between your current cash balance and the upper limit, whatever is the margin, that margin will be invested somewhere else. And if your money is going below the lower limit, the company should bring in more money by selling your securities or by taking a short-term loan, whatever way you want to choose. But yes, if it is below the lower limit, bring more money into your business. So in this way, the model tells the firm exactly when you are supposed to buy your securities or when you are supposed to sell your securities, so that cash always stays within the safe limit. So here you can see the understanding of the model. Upper limit is that it is the time to invest whatever extra is outflowing, whatever extra money you are having. So the water is outflowing from the tank, whatever extra water is outflowing, this extra water store it somewhere else, store it in the different container. And yes, definitely if it is moving below the lower limit, it is the time that we need to sell the securities and you need to put some more water into it. So Miller-Orr model, don't overflow, don't dry up, just stay within the safe zone. This is the basic understanding of the model. Let us have the view of what these limits are all about. And in this model, you will be deciding the three things. One is H, another is 0, and the third thing is Z. So H stands for the upper limit, 0 stands for the lower limit, and Z stands for the return point. So H is nothing but is the maximum cash the firm can hold. Fine. Z stands for the target balance the firm comes back to. For example, if you are holding more than the upper limit, it is necessary that you again come back to Z. If you are holding less than the lower limit, again it is necessary to again come back to Z. So what you are supposed to do? If more money you are having than the amount set at H, then in this case, cash reaches the upper limit, invest extra cash into the securities. So more money you are having, when you will invest extra cash into the securities, you will again come back to Z. Fine. If the cash falls to the lower limit 0, fine. In that case, securities add cash up to Z. So in this case, you will minus the cash. In case of H, you will minus the cash and you will throw it somewhere else. In case of 0, you will add up the cash. Fine. If the money goes beyond this minimum limit, you will bring in more cash. You will collect more cash from different sources. Either you take the loan or you sell your securities, whatever you want to do. But it is necessary that you are maintaining the limits based upon these things. So we must understand that this model is very useful for us. First, that this model will help us to save cost because company does not need to make too much of buy and sell transaction. Second, it gives protection against the cash shortages. So the firm always have money whenever they need it. And the third reason why this is important, it helps the company to manage uncertain, or we can say random cash flows in a smooth and systematic way. So in short, this model keeps the cash management simple. It keeps the cash management cost effective. It keeps the cash management safe. So by using these three parameters H, 0 and Z, you will be able to manage your cash if the inflows and outflows of the cash are totally random in nature and if they are totally unpredictable in nature. So here you can see, as I have told you, that this particular model is going to save your cost. This particular model is going to protect you against the shortages, and this particular model is going to help you in smooth running of our business by managing your cash flows. Now here are some key takeaways. So let us wrap up the entire session. So to wrap up, let us quickly go over the some significant points. First, here you can see that the purpose of cash management is to make sure that the firm don't keep too much cash, it don't keep idle cash, and at the same time it is necessary to avoid the shortages as well. So for that, first we discuss the Baumol's economic order quantity model that was given in 1952. It works best when cash flows are predictable in nature. It balances the carrying cost and the holding cost of the business. Fine. Whatever is the transaction cost and whatever is the holding cost, both the costs are considered for deciding how much cash should be there into the business. And then we studied Miller-Orr model. It is used when the cash flows are uncertain, which when the cash flows are random. It works best when we can decide our upper limit, when we can decide our lower limit, and when we can decide a return point. So by using this as a guiding principle, we can decide when to invest and when to sell securities in the market. So I can say that both models help firm to maintain the optimum cash balance. It helps us to maintain a certain level of liquidity. It brings a certain sense of stability, and it also keeps our cost minimum. So that's all for today's lecture. So make sure that you understand that how these models are used to determine the cash balances into our business. If you have any kind of doubt, you can write it into the comment section, and you can pause the video and look at this image which contains the entire summary of the lecture that we have discussed. That's all for today. Thank you so much. Have a good day.